Hello everyone, good morning and good afternoon. Welcome to today's webinar, Nonprofit Finance Fundamentals, featuring David Greco of Social Sector Partners. This webinar will focus on key financial sustainability issues to support your ability to develop and use financial information to make sound decisions and to better communicate your nonprofit's financial needs to your supporters, funders, and board. The Cornerstone On Demand Foundation is excited to sponsor this presentation, and we thank you for attending. Before we begin, a few housekeeping items. To reduce background noise, all lines have been muted. Please note that there is a chat box located in the middle right-hand side of your screen. Please feel free to submit your questions at any time, as we will have a Q&A session at the end of the presentation. Now, before I hand it over to our presenter, I'd like to take a brief moment to introduce myself and the Cornerstone On Demand Foundation as the host of this presentation. My name is Justin Waddell, and I work with the Nonprofit Empowerment Program of the Foundation, which was launched in 2009 in an effort to provide learning and talent management technology and pro bono HR consulting services to the nonprofit sector both domestically and abroad. Today's webinar is part of an ongoing nonprofit webinar series designed to support and provide best practices related to talent management and organizational development for nonprofit leaders. This webinar series is an extension of our HR Pro Bono Corps, a Cornerstone On Demand Foundation initiative which provides HR-related coaching and consulting to nonprofits at no cost. The HR Pro Bono Corps focuses its support in 3 areas: performance management, learning management, and succession management. If you're interested in learning more about how your organization can benefit from these services, please visit our website at cornerstoneondemand.org. Now, today's session and the associated slide will be posted to the Cornerstone On Demand Foundation's Nonprofit Ready Learning Portal within 24 hours. For those not yet familiar with Nonprofit Ready, it is the Cornerstone On Demand Foundation's no-cost professional development portal for nonprofits. In addition to housing all of the Foundation's webinars, Nonprofit Ready contains over 200 learning resources designed to help advance your nonprofit career and increase your impact within the community. You'll receive a follow-up email with a link to this resource within 24 hours. Please feel free to share this presentation with coworkers and friends. And now, without further ado, I'd like to introduce today's presenter, David Greco. David, thank you again for sharing your expertise today. I'll now pass it over to you.
Great, wonderful. Thank you, Justin, and it's a pleasure to be here today. And welcome to everyone who's joining us today on the webinar. My name is David Greco. I'm a partner with Social Sector Partners, a nonprofit consulting firm working to help transform nonprofit organizations, doing strategic realignment, strategic restructuring, launching new strategic directions, launching earned income ventures, all within the nonprofit organization to help make them more financially sustainable. Today's presentation is why we are focusing in on nonprofit finance. This is not meant or designed to be a training on accounting. While in many ways accounting, if you think about it, is how we measure things, finance is actually around the decisions we make off of what we measure. And this is really about decision making. As nonprofit leaders, as executive directors, as board members, as program directors, we're all being tasked to make a series of sometimes very difficult choices. And so the question comes in, what financial data are you using to help inform those decisions? And the challenge we have is that the financial statements we have, our audits, our 990s, they are designed as tax law and compliance documents. They are not designed as management tools. The IRS did not sit around and say, how can we create a management tool that will help nonprofit executives make better decisions, and then came up with the 990. The 990 is a tax document, and so our audits, all these other documents we have are not really designed for management data. So oftentimes, in order for us as leaders within nonprofit organizations to get the data we need to make better decisions and to help make sure that our nonprofit organizations are financially sustainable, we often have to slice and dice that data a little bit differently. And that's really what we're going to talk about today. As leaders, as executive directors, as program directors, as fundraisers, as board members, what data should I be looking at? What pieces of information on our financial statements are important for me as a manager and leader within a nonprofit organization. So I'll avoid, we won't be talking about FASB or GAAP accounting rules, well, at least not too much. And I'll try and avoid jargon as much as possible. But again, if I say something and there's a question you're not understanding, please enter the information into the chat box, and Justin and I will be monitoring that, and I'll try and make sure I stop at various points along the presentation to answer those questions. And with that construct and framework in mind, I'd like to go ahead and just jump right into the presentation, honoring everybody's time because we only have a brief hour together this morning. So I've mentioned these financial statements, and there are a whole wide range of different types of financial statements. And so I'm going to just talk, there's a couple that are actually prepared internally within the organization, such as budgets, either organizational budgets or program budgets, year-to-date results. Usually groups either do that monthly or quarterly. In terms, sometimes they'll do an internal balance sheet, and I'll explain a lot of these terms later for those folks that are newer to nonprofit finance. Most times people do the P&L, the income statement, year-to-date results. They don't often do the balance sheet, on an ongoing basis. Then we also have some financial statements that are prepared by outside accounting CPA firms, such as the audit. But underneath the audit, there are also some other things. There's something called a review or a compilation. A compilation is essentially the auditor will or the accountant will take your internal financial statements and put them into a standardized format. There's been no verification, there's been no checking, there's been no looking to see the accuracy of those numbers. They just put it into a standardized form. They just compile the data. A review is one step up from a compilation. They take your internal financials, put it into a standardized format, and they do some basic checking. Does the balance sheet balance? They look at some basic numbers to make sure that things look good, but they haven't done the level of testing and verification that you see in a typical audit. Where in an audit, they're actually going to come into your offices, look at your files, pull your check registry, look at your financial systems and processes to verify that the information being presented is as accurate as it can possibly be. So those are different levels of audits, review, compilation. And then, of course, there's the IRS Form 990, most often called the 990. Sometimes that's prepared internally if you have a financial office within your organization. If not, a lot of times that's handled by an outside CPA or accounting firm. Again, and that's the IRS tax document for that. So we're going to focus mostly on audits today, although there is a section I will talk about how do we get some of the data that we need off of our 990s as well. The other piece, and again, I don't want to talk a lot of accounting, but I just want to talk some basic accounting issues so make sure that we're all on the same page before we jump into the rest of the presentation. For smaller or relatively simple organizations, you might be actually what they call a cash accounting basis. That means cash comes in, cash comes out. It's just like your checkbook in your private life. You look at that, you see how much cash you have in it, and then when the bill comes in, you pay it, the cash goes out. It's a very simple, it's a straightforward transaction. A lot of nonprofits, although actually use accrual accounting, sometimes referred to as GAAP accounting. The main difference between cash accounting and accrual accounting is that accrual accounting includes receivables, money that is owed to you, but you don't have it yet. Basically, it's an IOU. And it also includes payables, what you owe to others. And the simplest way that I can explain this is I say, okay, in my checking account right now, I have $3,000, but my rent is due tomorrow, and my rent is $1,500. And so while my cash accounting would say, David, you have $3,000. Accrual accounting would say, David, you have $1,500 because you have $3,000 in cash, but you have a $1,500 payable, your rent, which is due tomorrow. So the amount of cash actually available is only $1,500. So that's the main difference. And so when you're dealing with accrual accounting, revenue does not necessarily equal cash. Because I could know that on Thursday I'm getting my paycheck for whatever, $2,000. And so that's a receivable that's coming in. And so in accrual accounting, we would actually count that because we know it's coming in, as well as the rent that we know is going out. Whereas in cash accounting, we just would simply look at the amount of cash we have on, and that's what we would say. So some groups use some type of hybrid. Most groups use an accrual accounting. I think it's an actually much more comprehensive look at your financials. It's more accurate looking at your actual financials. So again, but there are some cash accounting. So as we get into this, most of the presentations that we're going to talk about is using accrual accounting or GAAP accounting measures. All right. With that, now that we got the basics all under control, I'm going to go ahead and jump into the actual financial statements. And in doing that, again, we're going to talk a nonprofit audit here, recognizing not all of you may be using audits. And again, the questions we're going to ask, the data that we need is the same, whether you're looking at an audit, a 990, or an internal financial statement. The data you need is the same. How you get that information varies depending on the type of statement you're looking at. So I'm going to start with audits. We're going to talk 990s, and I'll make some references to internals as we go through. Primarily in an audit, and this is also true for the 990, but that there are really four different financial statements that we look at. The first one is called the Statement of Financial Position, better known as the balance sheet. So most people just call it the balance sheet. Technical term is Statement of Financial Position. Then the next statement is our Statement of Activities, often called the income statement or the P&L, the profit and loss. So to make nonprofit finance more confusing, we tend to have three names for everything. So I'll try and make sure that I use all the various names. So Statement of Activities, income statement, P&L, all are the same document: revenue, expense, surplus, deficit. Now, the expenses on our Statement of Activities is listed into program, general and administrative, and fundraising. That's actually not a very helpful breakdown of expenses. So they have a separate financial statement that's called Statement of Functional Expenses, which is where they take your expenses and break it down into the traditional line items: salary, benefits, occupancy, outside consultants, administrative costs. So you can actually see how an organization really spends its money. And then finally, we have the Statement of Cash Flows, how cash came into the organization, how cash went out. And the Statement of Cash Flows, remember, is a backward-looking document. It tells us how money came in and out last year or last quarter. It's not a cash flow forecast. It's not looking forward. So those are your four main statements and audits. We're really, today, just with our time limitations, we're going to focus on the first two, Statement of Financial Position and the Statement of Activities. So while the balance sheet, the Statement of Financial Position, is actually the first financial statement in audits, and in many, many ways it's the most important one, I would say most people actually are more familiar with and more comfortable with the income statement or the P&L. So for today's presentation, we're actually going to start there. But, you know, people, as they get more and more comfortable with nonprofit finance, they more and more start with the balance sheet. So as we look at our Statement of Activities, our income statement, or P&L, there's a couple key sections of it. And again, this varies slightly from audit to audit, but in general, these are some basic terminology. You have a term called support, and that is your contributed revenue. It could be from individuals, foundations, corporations, government, but it's grants. It's a contributed revenue. Then sometimes you'll have a term just called revenue, or sometimes they'll call it earned revenue. But if you see the word revenue on your audit, they're referring to earned revenue. That's fee-for-service contracts, ticket sales, investment income, money you get from selling T-shirts or hats, all of that type of things that are earned. that you sell a product or service and you get money in exchange. That's your earned revenue. So support is contributed, revenue is earned. We have this term called net assets released from restrictions, and I'll explain this in a little bit, but basically this is money you raised in previous years that you get to use this year. Because the restriction, the donor has placed some restriction on that money, as maybe for a specific program or a specific time frame that you can use it. So those are your revenue categories: your support, your revenue, and your net assets released are your three main sources of revenue, gains, and other support. Then we have our expenses. Again, program, management in general, and development or fundraising. Again, not very useful breakdowns of categories. So many times to actually figure out where an organization spends its money, we have to look at the statement of functional expenses. Then at the end, we have our surplus deficit. So we have all of our revenue and support, we have our operating expenses, and then we have our surplus deficit. In nonprofit accounting, they call that change in net assets, and I'll explain why in a couple of slides. Sometimes you'll call increase or decrease in net assets, but it's your surplus deficit. It's your bottom line. And again, I'll explain a little bit about net assets when we get to the balance sheet part. It's a little easier to explain it when we hit there. And so and we'll explain how your balance sheet and your income statement connect through your net assets. So part of starting to understand the income statement and is critical to this issue of understanding restrictions, because this is very, very different than the for-profit world. In the for-profit world, when we buy a product, when we buy our coffee at Starbucks, we don't put restrictions on that money. We can't say, oh, I only want this money to go to the barista. Or we can't say, I only want, if I buy stock in Starbucks, I can't tell them to say, I only want this money to be used for Frappuccinos in Los Angeles. We don't have any control over how the for-profit spends money. But in the nonprofit sector, we have this issue called restrictions. That means donors give us money, but they tell us how to spend it. And this begins to make our accounting more complex and cumbersome than what we see in the for-profit world. All revenue that comes into a nonprofit organization has to be put into one of three buckets, if you will. Right here, down here in the bottom, we see this unrestricted revenue. So that money comes in, and it's either earned revenue. Again, earned revenue, by its definition, is unrestricted. When you buy a ticket to the opera, you can't tell them to use that money just for the baritone. The opera can use that dollar for anything they want. So it's earned, it's unrestricted. General operating support grants, unrestricted contributions, annual funds, that all tends to be money that comes in, and the nonprofit can use that money however they would like. However, we get a lot of money in the sector that's temporarily restricted. That means it has either a purpose restriction. For example, it can only be used for the after-school program, or it can only be used in a certain geographic region, or it has a timing restriction. And most often that's a multi-year grant. And we'll use this example. You get a $100,000 grant. It's for 2 years, so that means you can only spend $50,000 each year. So that's a timing restriction. So you either have a purpose or a timing restriction. The third category of money in the sector gets put into is called permanently restricted. Most often these are our endowments. That means the donor has given you money, but he says, or she says, you can never, ever, 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 ever touch that dollar. You can invest it, and any interest you make off of that dollar, you get to keep the interest. But the dollar remains off limits forever, for perpetuity. And so the fact is, even if your nonprofit was to go out of business, the state attorney general will come, take your endowment, and give it to an organization doing similar programming. Because the state has to honor what they call donor intent. And if I gave the endowment money to be used for after-school programs, the state attorney general will come in, take that money and give it to another organization that's doing after-school programs because it has to honor donor intent. So this money is forever off limits. Now, the good news is money doesn't just stay in these buckets. They actually flow between the buckets. So let's use this example of this multi-year grant. Here we are in December 2014. I know there's some foundations that are currently doing their board meetings this week. They're getting ready to make their end-of-year grants to nonprofit organizations. And so let's say the ABC Foundation has given us a grant of $100,000. Their board meets today. We get the email from the program officer tomorrow saying, congratulations, you have a $100,000 grant. According to the accounting rules, we have to put that $100,000 in this temporarily restricted bucket. And so what happens is $100,000 comes into this bucket because accounting rules say you have to account for it in the year it was pledged. So the year you were notified or pledged that received that pledge, you have to put it in. So that means we have $100,000 now in this bucket here because it's December, but the money's for next year. And so what happens then is in January of 2015, you get to then take $50,000 and move it from the temporarily restricted bucket into the unrestricted bucket because you have met the restriction, which was this money can only be spent in 2015. So that means we have $50,000 now in the unrestricted bucket because we released it, and $50,000 in the temporarily restricted bucket for 2016. So that's how the restrictions work. The money moves from temporary to unrestricted. And the same thing, if you start doing work on the program, you start the after-school services, as soon as you start incurring the expenses for that program, you can release that money into the unrestricted bucket. So the money moves from temporary to unrestricted. And then over here in our endowment, again, as we earn interest off of that money, we get to use that interest to cover operating costs. So money flows between these buckets, but it all flows into this unrestricted bucket. Why? Because all expenses have to be paid with unrestricted dollars. We can't pay our salary and light bills with money out of the temporary restricted dollars. We can't pay our salary and light bills with our endowment money. That money is off limits. The only money we have to pay our salary and light bills is what's sitting in this bucket. So if you look and say, oh, I have $300,000 in cash, but that money is sitting either in your endowment or in your temporarily restricted bucket, you may still be missing payroll. So when for-profit people often look at nonprofit accounting, they get confused because this doesn't exist in the for-profit world. They don't have these restrictions. And so this is what begins to make the nonprofit accounting more cumbersome and more complex than what we see in the for-profit world. So I have a question here, and I wanted to just get to it real quick. You mentioned that earned revenue is unrestricted. What about if it's a fee-for-service where you give the partner a budget that they're paying for? So earned revenue is typically, again, when we're selling a product or service, we're doing consulting work, we're getting a contract. Anytime we submit an invoice and getting reimbursed, that's an earned revenue. If we're an arts organization selling tickets to our show or the theater, that's all earned revenue. If you're doing something where somebody else is covering expenses and you're not invoicing them, so if you're paying the expenses and you submit an invoice and get reimbursed, then that shows up as earned revenue. But if the partner says, well, okay, I'll pay for the room cost or the speaker's fee, that money typically would not regularly show up on your income statement or expenses. Some organizations, what they will do is consider that in kind. So basically, if someone else has paid for the room cost or somebody else has paid for the food at an event, we'll list that as our expenses as in-kind contribution. So it's not going to show up as cash that's flowing through our system. It's just showing up as an in-kind contribution, and it's typically then offset by an in-kind expense, basically saying, if I had to pay for this, this is how much it would cost. And so you have in-kind revenue and in-kind expenses when you have partner organizations covering that, but that would not show up as earned revenue. So good question. So this chart here that we're looking at, these buckets, these three buckets, is in many ways the start of understanding the income statement, the statement of activities. Here I have a typical income statement, a statement of activities. We'll call it the ABC Center. It's a very typical nonprofit. You see right off the bat, you see a couple of things right away, right? We see our support, just like we talked about. Down here, you see it's not listed separately, but you see our earned revenue. The investment income, tickets, dues, sales. And again, we have this net assets being released from restrictions. Now, net assets being released from restrictions typically is grant money. So the question is, why isn't it actually included as part of support? Why, and again, I'm going to get to this a little bit, I'm going to talk to it just a little bit, but one of the things that we need to understand is that for the purpose of the IRS, the question they want to know is how much new money came into your organization this fiscal year. So for them, when they look at support, again, we're talking from a tax perspective, they only want money that's up here that is being received in this fiscal year. So money that was received in previous fiscal years and you get to use this year, they're not counting that. And so we see this line that says net assets released from restrictions. And we see a negative 749 and a positive 749. And if we ask what's happening here, if we think about it, if we use the bucket analogy, simply what we're doing is we're taking $749,000 from the temporarily restricted bucket, which is this column here, and we're moving it into the unrestricted bucket here. And so this is an equal and opposite offsetting transaction. You'll see that the total equals 0. Because from the IRS, that money was accounted for in previous years, so they don't want to count it this year. And that this is the big difference between the 990 and the audits, is this net assets released from restrictions. And that's why net assets is its own line item and not part of support or earned revenue. Now, again, if we were to look at this organization, first thing we say, where is their contributed revenue coming from? Well, if we're here, we see that most of their contributed revenue is from individuals. Not saying that's good or bad or anything, but again, we just want to kind of get a sense of where does this organization get its money from? And then we say, do they have any earned revenue? Well, we see here this group actually does have a significant amount of earned revenue. In this particular case here, this is a health and human service organization, so they probably have a lot of government contracts. So sometimes you'll see under here, you see government grants or government contracts. Even if they call it a government grant, if you're submitting an invoice and getting reimbursed, the auditor is going to classify that as earned revenue, even if the government calls it a grant, quote unquote, because you were actually submitting invoices and getting reimbursed. From the accounting side, that's actually earned revenue. And then again, we're seeing that they get to use money this year that they earned in previous years. We have our expenses, and then of course we have our bottom line. Are they living within their means? So if I was to just ask a lot of people, if I was to walk out on the street here in Los Angeles, Venice, California, and say, how did this organization do? Most people are going to come over here and look under the total line, right? That's what we've been taught. Total, we go to the bottom line, and most people would tell me this organization had a deficit of $246,000. And from the accounting perspective, 100% accurate. From what we need to know as nonprofit leaders, a little bit irrelevant. Again, the question the IRS has, how much new money came in? We want new dollars. For the IRS, that means $1 million essentially came into this nonprofit in 2010 against $1.2 million in expenses. Therefore, they had a deficit of $246. That's not the same question, though, you need to know. As an executive director, as a board chair, as the program director, the question I want to know is, how much money do I have at my disposal to cover operating expenses? And to that question, this organization, the ED, actually had $1.7 million available to cover $1.2 million in expenses. And so the question are they living within their means? The answer is actually yes. They had $1.7 in revenue, $1.2 in expenses, $445,000 operating surplus. Even though the audit and the 990 will say they had a deficit. Because, again, they're asking a different question than what we need to know. Here, as you see, all expenses are in that unrestricted bucket. So where we need to focus as nonprofit leaders is what's in this unrestricted bucket. How much money do we have at our disposal to cover our operating expenses? And all these other transactions here is simply telling us how much the water level in those other buckets went up or down. So, again, focus on the unrestricted bucket. There's a question about QuickBooks in here. And, again, I don't want to get too much into QuickBooks because even though it has QuickBooks for nonprofits, they still use a lot of the for-profit terminology. So, for example, instead of using net assets, they call it retained earnings. If folks want to know, there's an organization called Fiscal Management Associates. Fiscal Management Associates, FMA. And they actually have a series of webinars about how to do coding in QuickBooks to better be able to track your data. And they're more of an accounting firm, and so I would, if folks want to have questions about QuickBooks, I would refer you to FMA. I think it's Fiscal Management Associates. I can't think of their website directly off the top of my head, but they have a lot of good resources. The other place you may want to check is a website called strongnonprofits.org. It's a website around financial management created by the Wallace Foundation out of Chicago, but it's free resources around financial management. And again, they have some stuff in there about QuickBooks, but FMA is a good group to go to talk about how do we adapt QuickBooks to actually get some of this information. So this is our statement of activities. Straightforward. Again, the question we're trying to answer, are you living within your means? Did you bring in enough revenue to cover operating expenses? To get to that question, we want to focus on this unrestricted bucket, not the total column. So, we've answered our first question. Are we living within our means? That's really what we want to know. The next question that I really want to focus on is this issue of risk and the nonprofit's ability to handle risk. Why is this such a critical issue in the nonprofit sector? Because if we look at the for-profit world, if we look at, and again, let's pick on Starbucks Corporation. If Starbucks Corporation goes out of business tomorrow, who ends up paying the price? Well, it's the investors. They are now lost millions of dollars because they bought all this stock and the stock is worthless. And so all the investors lose their investment. They are the ones who bear the risk. That's why they also get the rewards when stock prices go up. But when a nonprofit when for-profit closes its doors and goes out of business, it's the investors that are left holding the bag. But in the nonprofit sector, if a domestic violence shelter shuts its doors, who pays the price? It's not the donors. It's the people that are relying on those services. Risk in the nonprofit sector flows down to those who are most needy and vulnerable in our communities. They are the ones that pay the price when a nonprofit shuts its doors. So we need to understand how, if we're going to do something as a nonprofit organization, we don't want to do something that if it fails, will it take down the nonprofit with us? Will it take down our organization? Because if that happens, it's the people in our communities that pay the price. All right, so to get to this information of risk, which is really around liquidity, and I'll be talking about that in just a slide or two, the answers to this question lies on our balance sheet. Statement of financial position, better known as the balance sheet. It shows our assets, our resources, our debt, our liabilities at any moment in time. They often call it a snapshot in time. And also reveals our net worth. So basically, there's three key components to the statement of financial position, the balance sheet. First is our assets, everything that we own. And it's listed in terms of things that are most readily available in cash to things that take a lot longer to convert into cash. So things that are liquid, such as cash, to things that are very illiquid, such as P&E, property and equipment, buildings, fixed assets, tables and chairs. Those things are not, they are our assets, we own them, but they're not liquid. We can't pay our bills and salaries with them. So we have things like cash, we have things, receivables, money that's owed to us, we have our property and equipment. All are things that we own, and they're in varying degrees of liquid. So we have our assets, everything we own. That's balanced by our liabilities, everything that we owe. Payables is what we owe to our vendors or employees. Debt is money we borrowed and that we have to pay back. So we have assets, everything we own, minus liabilities, everything we owe, equals our net worth. In the nonprofit sector, we call this net assets. In the for-profit world, this is retained earnings or shareholder equity. In your private financial statements, this is your net worth. So we talk about high net worth individuals. That means they have a lot of unrestricted net worth. So we have our assets minus liabilities equal net worth. And if you look here, you'll see that our net worth is put into the same three buckets that we saw on the income statement: unrestricted, temporarily restricted, and permanently restricted net worth. So again, all money in the nonprofit sector has to be kept in one of these three buckets. So I call this our net worth. Technically, it's called net assets, all at the same term. Now, if I, in my personal life, if I bring in more money than I spend, what happens to my net worth? Well, it increases. If I spend more money than I bring in, my net worth decreases. And the same thing happens to a nonprofit. If a nonprofit has a surplus, that means they bring in more money than they spend, their net worth increases. If they spend more money than they bring in, that is, they have a deficit, their net worth decreases. So why we call a surplus an increase in net worth and a deficit a decrease in net worth? Because our surplus or deficit really tells us how much our net worth increased or decreased. That is why on the income statement that we just looked at, we saw change in net assets, not surplus deficit. Because from the accounting side, that a surplus equals increase in net assets, a deficit equals decrease in net assets or net worth. So that's why we have those terms. That's why we have this term change in net assets, not necessarily surplus or deficit. So our assets minus our liabilities equals our net worth. So when we're talking about liquidity, this is really what money does a nonprofit have to handle risk? What's our safety net, our cushion? If something happens and we need resources to draw, where can we get those resources? In our personal lives, we have our savings accounts, we have our retirement accounts, we have our kids' tuition funds, we have all these different pots of money that we can sometimes tap depending on the needs of our personal lives. In the nonprofit organization, they also have different pots of money, some of which they can tap easily, some they can't. Now, most people most nonprofit leaders, when they think around liquidity, they talk about cash, right? And we hear this term, months of cash. How much cash do we have? And so, again, we are looking at part of our assets, what we own, how much cash do we have? And so if we have $1 million in cash, we say, oh, I have $1 million in cash. But what's the problem with just looking at cash? Well, the issue goes back to that issue of restrictions. If that cash is sitting in our endowment, can we use it to pay our salary and light bills? No. If that cash is sitting aside for 2016, can we pay it for our salary and light bills? No. So just looking at cash isn't always the best way to give us an assessment of how much risk we can take, because that cash may be off limits and we may not be able to access it. So a better way to look at liquidity or our ability to handle risk is to look, remember at the income statement we looked at the unrestricted bucket. Here we are in the balance sheet, and guess what we're going to look at? You got it, the unrestricted bucket. That really tells us where our cushion lies. That is our safety net, because we're looking at our net worth. So that means we've already accounted for liabilities. So we've already accounted for money that we have to pay to others. We've taken our assets, we've minus our liabilities, and this tells us our net worth. And by looking at the unrestricted net worth, we are also accounting for restrictions. So we're not looking down here in our endowment, the permanently restricted. That money's off the table. Our temporarily restricted money, that's off the table until next year. All we really have is this unrestricted bucket. That tells me that money there, I own it free and clear, and I can use for any purpose I want. The challenge, though, again, just when you thought we had figured it all out, the challenge is that's not all cash in there. What's all sits in this bucket here, in this unrestricted bucket? Well, we have a couple things. One, we have our fixed assets, our buildings, our tables and chairs, our computers. If you're a nonprofit, those buildings and tables and chairs are part of your net worth. Just like as an individual, the car, my house is all part of my net worth. But can I pay my rent with my car? No. And just like a nonprofit, can you pay your salary and light bills with your buildings and tables and chairs? No. It's part of your net worth. It's unrestricted, but it's not liquid. Then we also have receivables, money that's owed to us. We've done the work, we've submitted the invoice, we have an IOU. But right now, I can't pay my salary and light bills with an IOU, but it is cash that will eventually come in, and it's unrestricted, but I just don't have it yet. But it also sits in this bucket. Third, we have board-designated restrictions. Board-designated reserve. That means the board has taken some money and set it aside. It's not the same as our endowment or permanently restricted, which means the donor has placed restrictions on it. In the board-designated reserve, that means the board has taken some of your cash and set it aside for a special purpose. Just like if you take some of your net worth and put it into your kid's college tuition fund or your vacation savings account, that means you have designated that. But if you've designated it, what can you also do? You can undesignate it. This money remains under the control of the board of directors. And from the accounting perspective, that means it's unrestricted. And so it sits in this unrestricted bucket, along with all these other categories. Finally, at the end here, we have our liquid net worth. So when we see this unrestricted bucket, we need to understand how much is rocks, how much is buildings, tables and chairs, how much is receivables, or how much is ice that's going to melt and eventually turn into cash, how much is set aside for board designated, and how much is actually liquid. And I'll walk through some of these in just a second. But it's clear to make sure that we understand, just like up here, that not all cash is available and ready to be used. Not all of our net worth, unrestricted net worth, is also liquid as well. people always ask, and we're going to jump the slide here, what's the right amount? And it technically varies. I mean, it really, really does, depending on each organization's risk tolerance, their business model. I personally, though, think 3 to 6 months is really a good amount of cash to have. Once you get below 3 months of cash, you're really in a much more reactive, crisis-driven state, because if something happens, what's your ability to respond? If you're in a situation where you have a couple weeks of cash, your executive director, your treasurer, your board treasurer, your finance director, what are they doing? They're trying to figure out how to balance payroll. They're figuring out which vendors do we have to pay, which ones can we delay paying. They may be asking senior staff to delay cashing their paycheck until the check from the donor shows up. And if that's what your senior leadership is focused on, just keeping the doors open and the lights on, they're not focused on the strategic long-term sustainability of the nonprofit. And so once you get out to more like 3 to 6 months of cash, that gives you room to breathe. That gives you some ability to handle risk, if there are payment delays, if there's delays in funding, if something doesn't happen, you're able to handle that. And if you get out beyond 6 months, you're in a much, much better position to be thinking strategically, to be planning, and then I like to see if an organization has more than 6 months of cash, this is when you can start putting money aside for reserves. This is when you can start building your safety net. But 3 to 6 months is a good amount of cash or liquidity to have on hand. The challenge is most nonprofits in the United States operate in usually in this area in here, in the 3 to 6 months of cash area. That's where most nonprofits are. And in some cases, probably about 20 to 25% of our organizations are actually less than 30 days of cash. And they're in this scrambling, this crisis mentality. And again, even if we're talking about cash, not all that cash is even available. So there is no official IRS guidelines or legal guidelines about how much cash you need to or have to, or if you have too much cash on hand. It's really based on each individual's organization's business model, their program areas as well. So we have about 13 minutes according to my schedule here, and so I want to hit the IRS Form 990, and then I think this should leave a couple minutes for questions at the end. So again, we looked at the statement of activities. The question we were asking there is, are we living within our means? Do we bring in enough reliable recurring revenue to cover our operating expenses? To get the answer, we have to look at the unrestricted bucket and see how much unrestricted money, which is money we brought in this year, plus our net assets released, and did we have enough money to cover our operating expenses? So that was our first question. Our second question is, what is our ability to handle risk? And to understand that, we have to understand our liquidity, and that is found on the balance sheet. And we have both. We can look at our cash, but the challenge with looking at cash, some of that may be restricted. We may have liabilities. And so a better measure of liquidity is looking at our unrestricted net worth. And sometimes some people call that LUNA, liquid unrestricted net assets. It's a long term, but I call it our liquid net worth. Again, that includes our buildings, our receivables, as well as our unrestricted cash. But the good thing about that unrestricted net assets is that money is free and clear. We can do anything that we want with it. And that really is, at the end of the day, that's really our safety net, and that's really our cushion. So are we living within our means? How much risk can we take? So when we're thinking about 990s, we can get that same information off the 990. We just have to look at it a little bit differently. First off, though, I just want to let people know that not all nonprofits have to fill out the IRS Form 990. You're supposed to have revenue of more than $200,000 or assets over $500,000. Then you're required to fill out the 990, which can then be put up on GuideStar for public access. So your 990 is public information. Your tax documents are public information. For smaller organizations, there's something called the 990EZ. So you can fill out that simpler 990, or you can even sometimes you can still fill out the full Form 990. Just if you're smaller, it's just sometimes easier to use the 990. And again, the thing I want to remember to show everybody, this is a tax document that the IRS is looking at. This is not a management tool. But it's one of the most readily and publicly accessible sources of financial information in the sector, so a lot of people use it. The GuideStar, Charity Navigators, Better Business Bureaus, Wise Giving Alliance all look at 990s. However, not all nonprofits need to fill out 990s. Obviously, if groups have not received their tax-exempt status, they can't fill out the 990 yet because you need the IRS tax exemption number. A lot of churches and faith-based organizations are not required to fill out the 990. State institutions such as state universities are not required to fill out 990s because they're actually considered part of the state. And just like individuals, state departments don't fill out tax forms, state institutions do not either. And if you're a subsidiary organization, either a fiscally sponsored organization or if you're just a local chapter of a national organization, it's usually the national organization that fills out the 990 and consolidates all the local affiliates, unless they're in a situation where you're actually a standalone, separate 501c3. But if you're a subsidiary organization, it's usually the parent organization that files the tax form. So in some of those cases, it gets a little, it requires an extra level of diligence to figure out some of this information. So let's look at the same questions that we looked at on the audit, but now let's look at it on the 990. So I'm looking here, I'm just taking an example of a page 1 of the IRS Form 990. And you'll see here they have revenue, expenses, and then the net assets, or basically did we have a surplus or deficit. So here again in our revenue section, again they have contribution, which is your let me clear all these things. You have your contributor revenue, program service, which is earned revenue, your income, again, investment income, other, and then our total revenue. Again, they're breaking it down basically in the same type of way, but they're using slightly different terms. They want to know contributed revenue, earned revenue, other types of revenue that might come in, and then your total revenue and support. And you can see over here what those numbers happen to be for this particular organization. They have contributed revenue of $239,000, program service revenue of $577,000 for a total revenue of $817,000. So that's the income for this organization. And then we'll look at their expenses. Again, what's interesting here, if you look at these expenses, this area right here, what do you not see? Well, you don't see program, general admin, and fundraising. The IRS actually, the 990 actually breaks it down into slightly different categories. Grants, which means grants that are paid out, benefits paid to members, salaries, professional fundraising fees, other expenses, total expenses. So these are not the same categories that we're used to seeing on audits. The IRS, they break it out in slightly different categories. Not that they're any more helpful. I find them probably even more confusing than what's on the than the audits. But again, if we look at this organization, we were up here looking at $817,000 in revenue, and now down here you see their total expenses is $719,000. And so they, whoops, sorry about that. So when they do their revenue less expenses, you see there's this $98,000 surplus. Now the challenge is, again, remember what the IRS is looking at. They're talking all new revenue. What we don't know is in some of these contributed revenues that we see up here, are these restricted? Is this money for the endowment? We have no idea. It doesn't tell us there. We have no idea if this $239,000 that shows up here in the top, is available to be used for the nonprofit organization. So they could end up having this surplus on paper, but they actually don't have access to that money because that money's sitting in their endowment. And so that the 990 makes no distinction between restricted and unrestricted. I'll show you how to get to that data, but you can't typically get it right off here. Again, prior to 2009, the 990s did break out program service, management, and fundraising, but they haven't done that since 2009. So that's an older classification, but I just wanted to point that out here. We have a couple minutes left, and I just want to hit just a couple more slides real quick on the 990. Again, I was pointing out this surplus here that the 990 shows this organization. So, but we don't know if that's really the amount of money that they have available. So, where we should actually look, I'm going to skip over this slide, but you'll have access to this slide later. Again, I've talked about that tracking new revenue. The better way to look at it is to look at the balance sheet. And again, you see the balance sheet here on the 990 as all of our assets, as our liabilities, and then our net assets, just like on the income statement, just like on the audit. But on the 990, again, we see our three buckets. All revenue in the nonprofit sector has to be put in those three buckets. And if we look at the difference here between the beginning of the year and the end of the year, we can tell if the organization had a real surplus or deficit. Because if this number, this 3.9, went to 4.2, the only way to go from 3.9 to 4.2 means we had to have a surplus because our net worth increased. And so that means the organization was actually living within its means because it actually did have a surplus because it went from 3.9 to 4.2. So that is a way to tell if the organization really had a surplus or deficit, or if that meant the money was actually restricted. Because otherwise what you would see is this temporarily restricted bucket going up. And this went up a little bit, but not as much as the unrestricted. So most of their surplus is actually real. So a couple key things as we wrap up here. One is nonprofits face risk. And if you don't have the cash and you don't have the liquidity on hand, then risk minus cash equals crisis. Nonprofits need profits. They need surpluses. Those surpluses help fund the organization. And they're increasingly seen as good measures of strong financial management for nonprofit organizations. The thing here again is to make sure that when we look at our financial statements, we're not looking at it from a tax law compliance way. We are actually looking at it from a management. So we need to know what to look for. Do we have the right data? Do we understand what that data means? Are we looking at the right columns? We're looking at the total column versus the unrestricted column. If we're looking at cash versus liquid net assets, they're going to tell us different data points. And then are we using that data to help make decisions? And so I know we're kind of really right at our time here today, but if there are questions and people want to know, if we don't have time to answer them today, I'll be able to probably provide written answers, and we can get those out to attendees later. I don't see any questions in the
yeah, David, I've been keeping track. We have had some questions be coming in, so I can go ahead and fire off from the top.
Okay.
All right, so our first question is, if a grant application asks you if you've ever had a deficit without specifically indicating that you should consult your audit, should you answer using the unrestricted column or the total?
For those things, they're actually referring to the total. They want to know in terms of from the IRS perspective, have you had or audit perspective, have you had a deficit? And so that's what I would answer there. If you have the room to provide some further explanation and to say this was due to a large infusion of a temporary restricted or restricted funding, to explain it a little bit, great, but they are asking about the total column.
Great. Our next question, what is the best way to track UR/TR/PR donations against expenses throughout the year and then determine UR/TR/PR net asset?
So when we get that unrestricted money coming in, it's oftentimes very difficult to track that during the year. It's often something that the auditor or accountant will come in at the end of the year and figure out what money is actually restricted, what money has met the restrictions and can be released. Groups can either do it one of two ways. If you have a grant that comes in, sometimes people just divide it by 12 and they release a set amount every month. And that works if you're doing something where your program is consistent and you're doing the same thing day in, day out. Otherwise, if you're doing a program that's a specific time of year, or say you're doing summer camp for kids, then you want to actually release that money as you incur the expenses for that program. And most people code your expenses according to certain grants. So you come in and say, okay, I'm coding this expenses to the after-school program, and every time then we do those expenses, we are then allowed to release an offsetting amount of revenue from those grants to cover those expenses.
Okay, great. And we've got time for 2 more questions. The first,
fire away.
Is there a need from an accounting standpoint to actually move temporary restricted funds to the unrestricted funds at the time those funds can be released from restriction, or is it just as accurate to spend the temporary restricted funds directly from the restricted funds?
And technically, from the accounting perspective, that money has to be released before it can be spent. And so technically what happens from the accounting side is you actually incur the expenses first. Say we start doing work on the after-school program, and then the money is released and covers those expenses. Now, in essence, it all happens at the same time, but from an accounting technical perspective, you cannot pay those bills directly from the temporarily restricted money. That has to be released first. Now, again, it's all instantaneous. It can happen just like that, but technically that's how it's going to show from the accounting side. So we often talk about charging expenses to a grant, and that's grant accounting, but in terms of organizational enterprise accounting, what happens is it's the money, it's the revenue that moves, not the expenses. And that's just an accounting, of how they do it from the accounting side.
Okay, great. And our second to last question, are all endowments permanently restricted, or is it up to the donor?
It's always up to the donor. It's always the donor's intent. And so if the donor says this is a permanently restricted money and we see you can never touch it, or if the donor may say, I know a case where a donor gave a group, an organization said for 10 years you have this money to invest, and then after 10 years, it can get released. And so it really is whatever the conditions the donor has put on it. Sometimes the board set aside money and they call it the endowment. Even if the board has called it the endowment, that is still a board-designated reserve, not technically an endowment.
Okay, great. And then finally, do you have a specific nonprofit accounting software that you recommend?
I do not. I know a lot of people use QuickBooks. I know there's a FundEZ, I think is the next level up. There's a set of different groups. Again, I would recommend people go look at FMA. They do what they call a back office assessment. They'll actually come in and look at your financial systems and give you recommendations in terms of what's the appropriate type of accounting software you should be using. And they also can work with you to actually set up QuickBooks to get some of this information for you. But I would use an accounting firm or somebody like FMA, Fiscal Management Associates, to help determine what's the appropriate level of accounting software that you would have.
Okay, perfect. And with that, we'll close out the Q&A. As
Wonderful.
a reminder to everyone, today's slides and the recording of this webinar and that Q&A are going to be posted to the Foundation's nonprofitready.org learning portal within 24 hours, and we'll be sending out the link to this very shortly. Now, I'd like to offer a big thank you to everyone for participating and for all those wonderful questions. And to you, David, thank you so much. This was really fantastic. It was really informative. And I think I speak for everyone when it was ridiculously engaging, and I really appreciated the knowledge.
All right. Well, thank you. I appreciate it. And again, if folks do have information, please feel free to contact me directly or Justin, and we'll get that information out to the group.
All right, wonderful. Well, again, thank you, David. Thank you, everyone. I'll leave this up for a couple seconds so you can copy down some contact information.
Yep.
And then again, as David mentioned, feel free to reach out to either of us. You'll be receiving that email from me shortly with any additional questions. So again, thank you, everyone, and have a wonderful day. If it's raining, stay safe.
Take care. Take care. Bye-bye.